So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Dr. Glenn Mueller. Dr. Mueller has 46 years of real estate industry experience, including 39 years of research. Dr. Mueller is internationally known for his market cycle research on income-producing real estate, his real estate security analysis research, and his public and private market investment strategies and capital market analysis. He's the academic director for the Keuren Family Office Real Estate Institute, developing research programs and real estate curriculum, specifically for family offices. Professor at University of Denver's F.L. Burns School of Real Estate and Construction Management, teaching and researching real estate market cycles, investment strategies, real estate capital markets. He has published 100 plus research articles and won many awards. He has authored 120 plus quarterly issues of his real estate market cycle reports. Dr. Mueller, welcome to the show.
Thank you.
Grateful to have you here. Very excited to talk today. I know this is a big question on a lot of people's mind. Where are we in the market cycle? But, we kind of talked off camera, but take us back in the beginning there, just kind of Reader's Digest version of what led you here.
Sure. Literally by chance, my first job was at United Bank of Denver and got thrown into the real estate group as an analyst and realized builders and developers made a lot of money and went out and did that myself for many years, and then went back to school, got my Ph.D. and I've been teaching and working for institutional investors literally for the past 30 or so years of my 45-year career. And just enjoy watching the markets and, seeing how things move.
Awesome. I love that. And you mentioned that you've been through 4 cycles now, potentially a 5th one coming up. When did you start to really hone in on this kind of cycles thing and really start that research of understanding these cycles?
Right. Well, I left University of Denver back in 1990 to go to work for Prudential Real Estate Investors. And that was a time, 1991, when the economy turned down and real estate was going through a down cycle as well. And they asked me to spend time researching and figuring out what had happened, why it had happened, and whether we could monitor it and predict it in the future. So that was really when it all started.
Awesome. So before we get into kind of where we're at, let's sort of define it. So first, I guess, kind of explain your real estate market cycle that you've developed, and then we'll get into kind of where we're at now.
Sure. And if it's possible, I'll actually just pull up one chart here. I'll flip my thing and let you see it.
Absolutely.
So if I go this way, better.
Perfect.
Whoops. So my real estate market cycle monitor report, which comes out every quarter, basically it is and let me now scroll down here a little bit. It's basically simply the occupancy cycle in real estate. There's really 2 parts to the real estate cycle: the physical cycle and the financial cycle. In the physical cycle, occupancies go, demand and supply create a cycle, just like it does in the economy. And when demand is stronger than supply, we go from recovery to expansion. When supply is higher than demand, which could be because demand's dropping off or we're overbuilding something, we go into the hypersupply phase, and then a recession phase. And as you can see here right now, this is my first quarter 22 cycle, that the major property types are pretty much all in the expansionary phase, because we've had this long expansionary period for the economy, basically 10 years long. We had a very quick 2-quarter recession with COVID, but demand for real estate literally turned around as the economy bounced right back from all of that as we went forward. So if we now just take a quick look here at the, I'm going to skip that because it's too hard to read. I look at each property type, and we'll talk about these kind of one at a time. So I look at demand and supply. Office, I'm going to call the one jump ball in real estate today. We are unsure whether people are going to come back or work from home. You know, every time we get another COVID spread, more and more people kind of look like they might be staying home. Companies want them back. They think they're more productive in the office. People are hoping for at least 2 days a week at home now, hopefully Monday and Friday. And you can see here that depending upon the market, they're in all different phases of the cycle here. And the reason for that is this. Every city has at least one or more economic-based industries. And an economic-based industry produces a good or service that it exports outside of the local economy that brings money in. So best example, Detroit, Michigan, the economic base is autos. And when the auto industry is booming, Detroit's booming. When it's not, Detroit is not. In this cycle, if you can read it, and I'll kind of go up a little closer here, you'll see Austin, Texas is in the recession phase of the cycle, okay? And Houston, Texas over here is in the recovery phase of the cycle. So let's just look at Austin and Houston. Actually, last quarter, they were in the same place. Why the change? Well, Austin, Texas is driven by the tech industry right now, and it's been booming. Austin has been one of the fastest growing cities in the United States for the past 5 years. It is just exploding there. And you're going, well, if demand is exploding, how can it be in the recession phase? And the answer is that Texas is an easy place to develop. The restrictions are less. The local builders knew it, and they put up more office space than needed. So we were in hyper supply for a while in Austin, and now that things have slowed just a little bit, we're in the recession phase because of more supply than demand. Okay, Houston, on the other hand, its economic base industry is oil, and pre-COVID, oil prices had been down, and during COVID, oil prices were down, and so there was no new demand going on, and things were, things were slow. They were laying people off. So again, we had low demand with not a lot of new supply. But now, since the beginning of the year, oil prices have taken off. The oil industry has immediately started to explore again and do things. They're hiring people. So Houston has gone from the recessionary phase, turned the corner, and demand is coming back up. Of course, in Houston, because of that slowing of demand, there hasn't been a lot of new construction of office. Hence, it's now got more demand than supply, and it's coming through the recovery phase. So you can see, market by market here, that things are quite different, and you really have to look closely for what's going on in your market. Okay. So let's now scroll ahead here and go into industrial. And as you might guess, wow, industrial is pretty much every market in the country is at its peak occupancy. We have had just huge demand. I'll call it the Amazon effect, right? For the past 5 years, more people buying things online. They want to get it shipped to them quickly. So everybody's been demanding more space. Any retailer that's going to survive needs to do more warehouse space, and today close-in warehouse space to make that happen, right? Amazon, through COVID, we went from 8 to 9 to 10 to 11 to 12% of all retail sales being online. During COVID, it jumped to 18%. When that jump hit, Amazon said, okay, things are even better than we thought. Let's build more, build more, build more. They signed contracts for new properties to be built. some of them that they haven't even moved into yet. And now that when COVID slowed and we reopened the economy, a lot of people went back to buying in the stores again. And the percentage of the first quarter of this year, the percentage of sales that were coming from online dropped back to 12.5%. So it went, 10, 11, 12, 18, 12.5. So Amazon said, oops, we kind of, I guess, overshot what we needed here. And so, they're looking to let go of or sublease space right now in the marketplace. You see one market there, Nashville, that's a little over the top. And that's because Nashville is one of the top industrial markets in the country. It's the trucking capital of the United States, and obviously also country music. But again, a little bit too much warehouse being put up there. And then you see three other markets, Atlanta, Memphis, and Salt Lake, that are just before their peak. As a matter of fact, the number behind them, if I get really closer, you can see the minus ones. That means that they were at the peak at position 11 and backed up a little bit to position 10, where it looks like it'll get absorbed and come back, but they had just a little bit of oversupply that should get eaten up here in the next quarter or two. Oh, and by the way, you see that there are 16 points on the cycle. Historically, real estate cycles have lasted kind of through two economic cycles and been historically about 16 years long. And the position on the graph tells you what occupancy level it is. And that tells you what kind of rent growth you're going to get. When you're at the bottom there at positions 1, 2, and 3, low rent growth, or negative rent growth, and then it starts picking up. Once you get to the long-term average there, the dashed line, you're getting kind of the rate of inflation, which over the last 10 years has been 2%. And then you get really strong rent growth over the next, during that growth phase, right? And last year, industrial had rent growth of 12%. Okay, way higher than inflation in any way that you want to look at it. Okay, and then in the hypersupply phase, rent growth starts to decelerate or slow down. It's still positive but strong. And then in the recession phase, it goes low and negative. So let's now scroll through to the next property type here. So with apartments, you see that pretty much 3/4 of all the markets are at their peak in the expansion phase of the cycle. A lot of people, when COVID hit, a lot of people moved home. Some were stuck where they were, apartment occupancies dropped, but the government stepped in and said you can't evict anybody, and they helped them with their rent, etc. But we still kind of went into the hypersupply phase. And when the economy opened back up and people went back to work, they all jumped back to their apartments. And I'll give you a fun example. One of the ladies I work with, young lady in Denver, working downtown, in a small efficiency apartment, paying $2,000 a month, walking 2 blocks to work, living the great life downtown as a millennial, going out to eat, going to the shows, doing all that kind of stuff. COVID hit, and working out of a 450 square foot apartment isn't so much fun, especially when, and this was a high-end, top amenity, swimming pool, commercial kitchen, full workout room, as good as any work, any health club you'd belong to, everything you can think of, rooftop, beautiful terrace, the whole 9 yards, all that was closed. So she and 4 friends went and rented a house out in the suburbs for a year. And when things opened back up, they came back into town. She went back to the same building, said, "Can I come back?" They said, "Yep." And the apartment rent's now $2,500. That is a 25% increase from the previous year because the demand is so high. We are seeing the highest occupancies we have ever seen in apartments, basically the same thing as industrial. You see a bunch of markets there in the hypersupply phase, just over the top. And that's because There was a lot of new construction going on during COVID. Most of the time, since you're working outdoors, they could continue to work. And so we just had a lot of new space coming online in about a dozen markets there across the United States. So their occupancy level fell by literally only 0.5%. Here, when we look at these numbers going from position like 10 to 11 to 12, it's only 0.5% change in occupancy that makes that happen. We are looking at occupancies being up, at this new higher peak of about 65%. And last year we saw an 11.4% across the country increase in rents. In some places like New York City, it was up 40. Like I say, in Denver, it was 25. And we're looking at, another 5% rent growth this year, asking rent growth this year. So, if you look back over the past 5 years, industrial, the number one demand, the number one performing property type. Apartments, number two. And so now let's scroll into retail. And here's probably the really big surprise for everybody. Retail doing really well. Occupancies at their peak in basically every single market in the country. Going, wait a minute, the Amazon effect was killing off retail. Well, wait a minute. If you look at what's really going on, retail had almost no new supply. It was only, pre-leased, built for it. So, and when COVID hit, we really separated retailers into two groups: the COVID haves and the COVID have-nots. Okay, if you were deemed essential retail, you were open, you were busy. If you were a fast food restaurant, there was a line around the block trying to get in and get something to eat, right? And if you were a Home Depot or a Lowe's, because building materials were deemed essential, their sales were off the chart. Prices were going up. They are opening more stores. The place that I go to for my lumber and building materials here, they had a 100,000 square foot store. They just tore it down and they're building a store 4 times its size.
Wow.
Which is just amazing, right? So grocery anchored shopping centers open, Walmart open, Target open. They are expanding and growing because their sales were just through the roof. The COVID have-nots, a lot of them shut down, and that space is being reused for close-in warehouse. Some of them are being converted to apartments, right? And retail over the past few years has been converted to office as well. So it's a question of very lower demand, but even lower supply. So demand growing faster than supply. And as things reopened, retail got very creative. One of my good friends, professor at Harvard, his son is the main guy at a developer in Canada, and they own regional malls.
Oh,
and
wow.
when Sears moved out of their regional mall, what they do? He replaced it with a Porsche dealer, and they do their service there, so that instead of having to give you a ride home, they said, go shop in the mall for a couple hours while we're taking care of your car. So, retail is, there's an old saying, retail is creative destruction. You come up with something new and kill some people off, but you grow from it. Amazon in 2019 opened 250 of its new grab and go, touchless Amazon stores, convenience kind of stuff in downtowns. So even the internet retailers are doing brick and mortar to make things go. Okay, so then let's move on to our final property type here, which is hotels. And hotel is a story very similar to retail, or to, at this point, where when COVID hit, you had COVID haves and COVID have-not hotels. Business hotels shut down. New York City really having a big problem. There are many hotels in New York City that probably won't reopen. If you were a drive-to hotel or on a highway, you were just jam-packed and full. Hotels obviously took a big hit when everything closed down for about a month or two, and then if you could get there, you wanted to get away, and the prices in hotels have gone up dramatically. So it's hard to look at an average number in hotel today, but you can see at the top there are the major resorts: Honolulu, Fort Lauderdale, Jacksonville, Miami, Phoenix, and Salt Lake is there only because of skiing for the winter, right? At the bottom, over here, you got Chicago, you got Cleveland, Columbus, Detroit, Hartford, Minneapolis, markets that are more business oriented. New York City's down there as well. So it'll be interesting to see what happens. And again, one story, I sit on the board of a opportunity fund, and we had made a loan to a hotel just outside of New York City on Long Island, right on the water. This was a high-end resort hotel, $1,000 a night rooms, and normally, full all summer. Fall is kind of off season, and then starting Thanksgiving through Christmas, full again. They were 100% occupancy all through the fall because people could drive 1 hour to get there. So, it's quite a unique situation that we have here. And obviously having people that really know what they're doing in real estate, understanding the property type, where they might find demand, and trying to figure out how to fill that space, is the real challenge that's out there today. You probably all heard that, Amazon, like I say, is now going to try to either sublease or get out of 10% of all the space they have, which is a lot, right? But there are plenty of retailers out there that are being told, we're being told, hey, we won't be able to get you space for another year or two to get it up because we have that many contracts in front of us. We're seeing that in home building as well. And obviously the prices there are up, which means you got to have higher rents to cost justify building that.
Yeah, absolutely. I really appreciate all of that. That's very, very detailed. Another thing I'm noticing is some of these cities, especially here in the hotel, you can kind of see which ones got really hit hard by COVID. Not necessarily for sure, but some of these were more affected by COVID than others.
Absolutely.
And definitely taking a little longer to rebound.
Right.
I think COVID also put into perspective of where people like to go and want to go.
Yes.
In terms of like travel.
Right. And now that you can travel again, it makes, that makes a big difference too.
Yeah, absolutely. So now that we're coming out of this, obviously it's market by market, but we're, at least what I've seen, we're still very undersupplied in terms of, let's just take apartments, for example. As a whole, do you feel, and I saw in there that there are just getting into that hyper supply phase. Is that because those are places where people just really don't want to be?
No. In almost every case, it's because there were a lot of new apartments under construction that literally just got finished here in the first quarter of 2022. On average, we are 4 million housing units short in the United States right now, and that's either house or apartment. And it's because during the Great Recession in 2008 or 2009, a lot of home builders, and by the way, I want to tell everybody that you have to separate home ownership from income producing real estate, and I add apartments into income producing. So yes, you could own a single family home that you rent, and that's okay. But as far as home ownership is concerned, the only way to invest in that is to invest in a home builder. They take land, sticks, bricks, and other raw materials, build the house. When they're done, they don't make a dime until they sell the house. And as a home builder myself, we used to have a saying, carry kills. If I finish a house and it doesn't sell, every month that interest on my construction loan, in 9 months, I eat up my profit and I'm down to break even if I can't sell it in 9 months. So a lot of home builders said, well, we're going to be more conservative going forward. And they didn't build as many, units. Yes, you could, you could, do a custom home for someone, but most of the housing in the United States today is built, if you will, on speculation and for sale, right? So they cut back on that, and we were building at about 50% of the norm throughout 2010 to 2020, and we were building a lot more apartments, but not enough to make up for that. The average age of a first-time home buyer in this country is 36 years old. And so those millennials who are, finally headed out to buy that first house, because the supply was so low, are being priced out of the market, if you will, because there'd be multiple bids, 5, 10 bids on it. Just heard a lady say, I bid on 20 different houses and I bid above asking price. And in every single case, the real estate person came back and said, we had further offers above your offer. So that is keeping people in apartments as well. And so all those markets that you saw going into the hyper supply phase, that will actually back off, if you will, and get refilled here probably by the end of the year. So I wouldn't worry still at this point about investing in industrial or apartments or rental housing at all. The demand is just through the roof.
Absolutely. Yeah, I couldn't agree more. And I know that sentiment is kind of echoed throughout the industry, even as we see, the stock market doing what it's doing and supply chain issues and different things like this. So what indicators are you paying attention to, that could indicate a cooling off or a slowing, I guess? Is any of this going to come to a head at some point?
Right. Well, the answer is demand for real estate comes from employment. Forget unemployment. There's 4 different numbers that you can use for unemployment, et cetera. But every time someone's employed, they need a place to work and they need a place to live. So if employment is up, then demand will be up. And all of you should go to the Bureau of Labor Statistics, which is bls.gov, and sign up for their emails. I get the employment number. It comes out every month, and it's absolutely 100% accurate. And I'll tell you why. It comes out every month. It comes out at 8 o'clock in the morning. I get it, and all the rest of you hear it on the evening news. So I know about it 8 hours before the rest, before the general public hears about it. And the reason it's so accurate is every one of you knows every time you've ever gotten a job, day one, what do they have you fill out? A W-2 form that gets sent into the government. So we have an absolute accurate number on people that are employed. It's that simple and straightforward. And it, bounces around by month. It's been 120,000 one month this year so far. It's been 442,000 one month this year, and it's still strong. And of course, they tell you that unemployment is low too, but if someone isn't applying for unemployment and just not working, then it doesn't show up. That's why it's an inaccurate number. But if that number just continues to grow, demand for real estate will be there. Even if the economy slows down, unless they start laying people off, when we start to see, a zero employment growth in any given month, that's when we start worrying. But at this point, I don't see that happening. Every one of my students who's graduating from the University of Denver here next month, they have at minimum 2 job opportunities.
Wow, that's awesome. And that's great to hear, because I know that hasn't always been the case.
Correct.
So as we move forward, obviously, like you mentioned, a lot of demand. That's great to hear that's really the number we should be paying attention to. as interest rates increase, a lot of things kind of changing. Do you see a shift in any of these markets that, like any markets that may be shifting that we should pay attention to?
Well, you know, anytime an economy grows and there's big demand, that creates more inflation, and that creates, the government tries to slow it by raising the interest rates. So, and they have always been very successful at that. Even when they just start tapping the brake a little by raising the rates, it causes the economy to slow down. Most of our inflation has come from supply side restrictions due to COVID, and that is kind of the real problem. And of course, now the Russia war is not helping things either. So that's going to kind of force a slowdown, if you will, going forward. But the question is, there's still so many people without that need employees. I don't think that's going to they're running at a lot. Restaurants is a good example, are running at 75% of capacity because they just can't get the people to come and work. So it's a difficult situation there. We had negative GDP growth in the first quarter but I think that was just people saying, whoa, let's hang on here and not spend a lot of money till we see how things sell out. Second quarter could be the same way with a little bit lower GDP growth. Normally employment follow, and GDP kind of go together. That didn't happen though. GDP fell down, but employment was still up. So really, I believe the key is watching employment growth.
Interesting. Awesome. I really appreciate that insight. And I know the listeners will as well, because especially I think we're in a time now we haven't really seen before, right? And I think a lot of these, and obviously you can speak on this, but I think every sort of recession or downturn is triggered by something different. Is that typically correct?
Yes.
Or I guess something leads it more.
Right.
The leader is kind of something different, I guess.
Right. Yeah. And it's many times it's some kind of event. It's the government raising interest rates to slow things down is typically one of the most historic things. Many of the recoveries have been by housing picking back up. And now that we have higher interest rates, it'll be interesting to see what happens, because obviously people qualifying becomes harder.
Qualifying, and then when you do qualify, what you can actually afford, decreases and different things like that. But like you said, then that just pushes people back into the apartment industry or back into apartments. So, you could, I guess, see a slowing in home sales, but that doesn't necessarily mean that as apartment investors, we're going to see a slowing in our demand as well, right?
Well, and the other thing that's happening is so many millennials would like to get out of the apartment, get into a house, because now they've had a kid or whatever and need a yard. And so the for rent single family homes is a whole new subcategory that is growing like crazy. And many institutional, and there's a couple of publicly traded REITs that do that. The institutions started getting into it. One of the big pension funds just jumped into a private fund, putting in $500 million
Wow.
to invest in for rent single family homes. So we're seeing big demand there.
That's fascinating and great to see, because ultimately, we do need to solve this undersupply issue.
Right.
I've been reading and seeing that the entire global market is working to fix the supply chain issues. A lot of warehousing and even manufacturing being moved to completely different countries. Do you have a general outline, or what do you see in terms of, maybe that easing up as well?
Well, and so one of the terms I hear a lot now is reshoring. We used to send a lot of stuff offshore. Now companies are saying, let's bring it back. And one of the problems, of course, is finding people to work in that manufacturing process, but robotics are doing a lot of that work now that used to be not done. I just got an email from a company called Boxable, and they have come up with a way to build housing units in a factory completely robotic, and they fold together and fold up, and they become 20-foot by 20-foot modules. And then one module will have like a kitchen, a bathroom, and a room, so you could have your own little 400 square foot mini apartment kind of thing. Well, you can stack them and that kind of stuff, so you could literally create an apartment building that way. Or I want to do a house. Okay, I want one that's a kitchen, I want one box that's a living room, I want one box that's 2 bedrooms and one box that's 1 bedroom. Put the 4 of them together, and I got a big house. Got a 1,200 square foot house. So that kind of stuff, is one of the ways to solve that. There's modular housing, great product. I've built a number of modular homes myself, and I actually 3 years ago built a modular office building with apartments on top for my son in Minnesota.
Oh, wow.
So we set 4,500 square feet in 6 hours.
Holy cow.
Yeah.
Oh, okay. Awesome. So obviously a lot of people leveraging technology, and that innovation is going to come, and there may even be things we don't know yet that are being developed to help kind of combat this issue. Obviously, China, Asia is still struggling with COVID, or whatever they want to call it. So.
Correct. So it's a interesting time. I think eventually, obviously, technology can overcome a lot of problems. Everybody kind of wants to be downtown, but we don't have enough roof space to turn everything solar. Whereas just heard a longtime friend from MIT, professor there, his new theory is with solar, single family homes could be 100% off the grid with the batteries in the garage, and charge your car and everything else. So all of a sudden, it's going to be better to be in the suburbs, and be energy independent, and off the grid, and environmentally friendly in a single family home where you've got plenty of roof space for those solar panels, as opposed to downtown where you got a tall building with not a lot of roof space. So who knows which way that'll go, but that's a very interesting idea.
Absolutely. That's very fascinating. I know that I talk to people who invest in like rare earth materials, like the stuff that go into cell phones, and they're talking about in the next 10 years, that stuff being implemented into like windows and things like that to power homes and different renewable sources. But awesome. Well, I really appreciate all the insight. I know the listeners will as well, make us feel a little bit better about continuing to stay bullish on commercial real estate, despite it's important not to get too caught up in what you hear on the news anyway. So
yeah. And all the institutions, all the pension funds and endowments have been increasing their allocations to real estate, so the capital is going to flow in. I don't see prices going down. We just started the Family Office Real Estate Institute. Wealthy families have kind of doubled the allocation to real estate that the institutions do at this point. And for them, it's a hard asset that doesn't go away. In other words, you don't lose 50% of your value overnight in the stock market. So
tell me about it. I just wrote a blog about that. So
right.
But yes, I'm officially completely out of the stock market, and full send into real estate for the foreseeable future. So
well, I got out last December because I figured that there was a high chance of the capital gains tax going up. So I got out at the end of the year and actually rolled my money into an opportunity zone, which is something you should talk about sometime, which defers that capital gains for 5 years, and actually just started to nibble and buy back in a little bit with the market down 20%.
Awesome. Yeah. Touch on opportunity zone for those who don't know what it is.
Okay, so most of you have probably heard of a 1031 exchange, where when you sell a property, if you reinvest the money into another property, you defer that gain until you sell that property, and you can keep doing that over and over again. Your basis is, the original amount you spent. President Trump actually put this into place to try and stimulate the economy. Every state got to select 30 areas in their state that were called opportunity zones. In other words, places where the area needed help, it was underemployed, that kind of thing. If you were to put money into a project in one of those zones, it has to be built within 3 years and that kind of thing. And when it's done, it has to create something that employs a minimum of 10 people. You got to take and you could do it with anything too. You could sell stocks, which is what I did. You could sell a company. You could sell your real estate. You could do any of that kind of stuff. You would defer the gain for 5 years. So if you made $100,000 and then you're going to pay the 23.5% tax, you don't have to pay that tax for 5 years. And this is over now, but if you had kept, you gotta step up in basis of 10% in 5 years and 15 in 7 years. Little extra detail, but every single dollar of gain of the investment you put into, tax free. So if I put in 100 grand and you have to hold it for 10 years, if I put in 100 grand and in year 10, day one of that year, sold it for 150, that $50,000 is 100% tax free. So it's a great place to put profits that you made from anything into a deal. Now, picking the deal is the important thing. It has to be in an opportunity zone fund. So picking the right fund manager, very important, and the deals that they're doing. I sit on, like I say, the board of an opportunity zone fund, and we're doing mainly apartments in areas. We did one, believe it or not, in northern Manhattan.
Oh, wow.
We did a student housing project in Las Vegas in an opportunity zone in a blighted area of Las Vegas, and it opened during COVID, still 100% full.
Wow.
So it's very important to pick the right deal. You don't want, like in Nebraska, they said, well, this area in the middle of nowhere should be an opportunity zone fund along the highway. Well, nothing's going to happen there. So you got to be careful.
Interesting. Okay. That's good to know. And yeah, appreciate that insight. So you mentioned that the gains aren't taxed. The gain that you made from the stock market also not taxed because you.
No, it defers
that
tax for 5 years.
Wow. Yeah. So all you have to do is just show that you took the proceeds and put it into one of these opportunity zones, and it's deferred. Wow.
You have 180 days to do it. Yeah.
That's incredible. Yeah. That's awesome.
So, yeah. So, by the way, my market cycle report, you can get that at the Family Office Real Estate website, which is very simply FORE.institute, and find my market cycle reports there.
Awesome. We'll definitely sign up for that. Cool. Well, that brings us to the final 5. I've appreciated all this insight. It's been incredible. I've got 5 questions I ask all of my guests. First question, best advice you've gotten from a mentor?
Good question. Be humble. If you're good and you're smart, people will know it from what you do. Don't go out there trying to sell yourself.
Ooh, I love that. That's awesome. What is it about your career that makes you feel like you're fulfilling your why?
I believe, and I tell every one of my students this, God gives everybody different gifts. Figure out your gift, do it for a living, and it doesn't feel like work. I absolutely love what I do, and I enjoy it, and I'm motivated by it.
Oh, I love that. Favorite non-real estate or investment related book?
The Bible.
Nice. gotten that one a lot. A lot of people like the Proverbs as related
Yep.
to business. If you could have any superpower, what would it be?
For me, the gift of healing.
Nice. That's a good one. I like that.
Yeah, I have so many people with, students and friends and that have problems. Just being able to heal them would be awesome.
Absolutely. Now you kind of mentioned the website for the newsletter, but what's the best way for people to get a hold of you and learn more?
Yeah, it's my email address is Glenn, Glenn .Mueller, Mueller @4.institute.
Awesome. Well, Dr. Mueller, thank you so much for your time and all of your insight. I really, really appreciate it.
Thank you.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.